With Pramod Gubbi, co-founder of Marcellus Investment Managers. Pramod, great to have you on the show, and it's after a gap. So first, let me start by wishing you a happy new financial year. Just taking a cue from our colleague there who's discussing a couple of these defense stocks. Now, let me straight away cut to the chase. We know that some of these, manufacturing heavy, intense themes is something that Marcellus as a house has really stayed away from. But what's the thinking now, given that the PSU rally is showing no signs of sort of cooling off and defense stocks continue to find traction in the market as well?
Yeah, no, thanks for having me here. I don't think we have anything against manufacturing. Where it stems from is we look for businesses which are self-sustaining from a longer-term perspective. So therefore, the starting point remains the business has to generate a return on capital greater than cost of capital on a cross-cycle basis. Most asset-heavy businesses in India have struggled to do that. Having said that, there are a whole host of, I would put them as quality industrials or quality capital goods companies, which are exposed to more constructive industry structures, in the sense better working capital management because of the nature of the customer base and so on. So one of the distinctions that we need to make is where the industrials company or the capital goods company is exposed to more private sector capex than public sector capex. Because historically, companies exposed to public sector capex have shown poorer fundamentals on the return ratios, working capital, free cash flow generation, and therefore our preference for companies exposed to the private sector capex. Given the nature of private sector capex in India, which has been largely absent for the last decade or so, we've had little luck in finding companies exposed to this cycle. But we're at a stage where we reckon the imperative is clear, both from the Indian economy standpoint, that the private sector takes on the baton from the government, which has done much of the heavy lifting as far as investing in hard industries is concerned. We're seeing the beginnings of that. We're seeing the beginnings of a private sector capex cycle. So we're quite actively interested in looking at businesses which are beneficiaries of that. In fact, it will be one of the more bigger themes from our perspective, looking ahead for the next 3 to 5 years. So if we have to pull out of the current situation that we have as an economy where you have a slowdown in consumption, given the nature of the global economy, exports are also slowing down. Like I said, the public capex has held strong all this while, but now given the imperative for the government to sort of reduce the fiscal deficit, which was bumped up during COVID, it is imperative that the private sector capex activity picks up, and if that happens, we will get into a much more sustainable path on the economic growth front, because that will lead to job creation, which in turn will help consumption. And so it is a big focus area for us to find high quality industrials and capital goods companies exposed to private sector capex cycle.
Okay, so that's your big theme, right? Playing the recovery, the pickup in private sector capex over the next 3 to 5 years. So, explain in a little more detail how you will play this. Top of mind, I think it's private sector banks which come to your mind, or banks in general come to your mind, which will be beneficiaries, of this investment cycle. So, how do you pick the stocks over there and even outside of banks and financials?
Yeah, no, you hit the nail on the head. The obvious play is around private sector banks, partly because they will benefit from any sort of credit growth that will happen. A couple of the private sector banks have had a long track record in funding the capex cycle in India, at least on the private sector side. Add to it the fact that the last couple of years, the private sector banks haven't gone anywhere, making their valuations look seriously attractive from a historical perspective. You get the downside protection on the valuation front. At the same time, you get exposed to the cycle as they participate in this credit growth. There are companies in India which make machinery that goes into factories as Indian manufacturing takes off, which will also benefit from this sort of a capex activity, be it gears or machines that go into the manufacture of setting up of factories. Those would be natural beneficiaries on that front. You can look for proxies through, building materials being sold to the build out of the Indian factory base. Those could be a proxy or an offshoot of the same fundamental driver in the economy. But all of this will have to fit into our investment philosophy around good governance, capital allocation, and competitive advantages. Luckily, we are blessed with a number of such companies in India, which creates a decently large universe for us to pick from.
Pramod, hi. So just to go back to that point on industrials, and it sounds to me like it's a bit of a pivot because you're now looking at some of the high quality names where capital allocation policies are in place. So can you just elaborate on that? I mean, I'm just drilling down a little further because valuations perhaps have really run up. Would you be looking at larger companies, the tier one, the ABB, Siemens and the likes, where, I mean, governance, etc., probably things are taken care of, at least those aspects. So would you be looking at tier 2, tier 3? I'm also looking at additions to your Little Champs portfolio last 7-8 months. I mean, you've added stocks like RHI Bangalore, there is Tega Industries, there's Shanti Gears. So I don't know how much of this really classifies as pure industrials, but just trying to understand what the thought process will be in terms of stock selection going forward from here.
No, absolutely. I think valuations are an important concern, which is why we reckon that the large cap industrials, perhaps within the quality space, we would wish if they were available any cheaper. But mind you, if you're looking at a 3 to 5 year cycle, there could be plenty of earnings momentum, which can justify these valuations. But from our perspective, rather than just looking at large caps, we are more bottom up. We're more than happy to look at some of the small and mid cap plays, because that's a much more wider and deeper universe. And indeed, the recent rally in small and mid cap of the last year hasn't seen much of a participation from quality plays. It has been driven off certain themes, such as we spoke about defense or EMS, where PSUs or businesses doing business with PSUs have benefited a lot more. To that extent, in the small and mid-cap space, if you focus on quality industrials, you will still be able to find good picks. So that's why you see the list on the screen. Whereas in large caps, we would hope for some sort of a correction or a better entry point or earnings momentum to pick up to the extent that we can see those valuations being justified.
Okay, all right. Slightly shorter chat, but a very interesting one. And we'd love to sort of expand on it, talk about some of the other themes as well that you're bullish on for this new fiscal. And we will do that over the next call. Thank you very much for joining in today. Well, with that, we do have to take a very quick break. We will come back on the other side and get you more on the markets and, of course, some updates as well.